In Part 1, we looked at the historical origins of bookkeeping. Westerners might like to believe that it was developed in Europe in the Middle Ages, but it seems that it was borrowed from systems developed earlier by people in other cultures and adapted for European use in the Middle Ages. This had already been done at least a century before Luca Pacioli published his Summa di Aritmetica. In Part 2, we'll look at how bookkeeping is done theoretically. It's not so much about helping you to actually do the books, as it is about learning the fundamental accounting algorithm at the heart of double-entry bookkeeping. Muhammad al-Kwarizmi, circa 750 to 850 AD, was a Persian mathematician and is credited with being the father of modern algebra. In about 820, he wrote the Compendious Book on Calculation by Completion and Balancing, which was translated into Latin by Robert of Chester in 1145. It was used until the 16th century as the principal mathematical textbook of European universities. As we discussed in Part 1, there are two fundamental accounting equations at the root of accounting theory. When I checked with CoPilot about the importance of equations to the study of algebra, this is what came back. Equations are not just one topic within algebra. They are the structural core around which algebra developed. Without equations, algebra would collapse into mere symbolic manipulation without purpose. But before we get down to how accountants keep the books, we need to know a little algebra. Hopefully you were paying attention in grade 9 or 10 when your high school math teacher tried to get through to you. At the time, you were likely distracted by social media and your classmates, particularly the cute 1-2 desks away in front of you. In case you were a little too distracted in high school, there are no end of online options to refresh your knowledge. They range from free to cheap, often costing less than bus fare, to and from your local adult education center. While the algebra isn't all that complicated, we'd recommend you check out YouTube or the Khan Academy if you're worried that you won't get it. There are two fundamental rules when recording transactions in accounting. First, when we record transactions, the sum of debits must equal the sum of credits. So what are debits and credits? Accounting is the recording and compilation of transactions, each of which involves at least two parts. By convention, we call these two parts debits and credits. Debits and credits aren't inherently good or bad. It depends on the context. In the same way, money is good if you have it, but not so good if you owe it to someone else. At its simplest, transactions can merely involve the exchange of goods for money. A transaction can be much more complicated than that. But let's not get ahead of ourselves. No matter how many parts a transaction has, the sum of the debit parts must always equal the sum of the credit parts. If we record transactions correctly, the sum of all debits equals the sum of all credits in our accounting system. In other words, if we record transactions all correctly, when we compile the transactions into a working trial balance or a set of financial statements, somehow, as if by magic, the sum of assets equals the sum of debts owed to others and the business's equity in the assets. So what do we mean by assets, liabilities, and equity? Accountants call debts liabilities, and the owner's share in the value of the assets is called their equity in the business. To illustrate, when you buy a house, your down payment is your initial equity in the house, and the mortgage is considered a liability against your house. The house itself is simply your asset, valued at what you bought it for. In this slide, we have simply translated the balance sheet equation into ordinary English. Here we have expressly stated the equation that underlies the income or profit and loss statement. The profit earned in the year is calculated by subtracting the expenses or amounts spent to earn income from revenue or sales earned by the business in the year. Finally, at the end of the year, income for the year is added to equity. Or, in the case of a loss, the loss is subtracted from equity. Afterwards, we zero out all of the income and expense account transactions for the year. This single transaction is called the post-closing entry. In this slide, we illustrate how debits and credits affect the different types of account. Assets are increased with debits. Liabilities, equities, and revenue are increased with credits. And finally, expenses, like assets, are increased by debits. Here we put together a kind of cheat sheet to help you remember how each type of account is affected by debits and credits. Building a cheat sheet like this can help you internalize the accounting algorithm, particularly when you're just starting out. This presentation wasn't really meant to be a how-to guide for bookkeepers. Instead, we hope it can serve as a simple reference to the logic underlying the bookkeeping process. At SBA Canada, we've put together a few short workshops that can show how this logic can be employed when you are performing bookkeeping and compilation work. Thanks for listening.